All right, I think we got everything ready to go. Happy Monday, everybody. Looks like we got a little bit of a rally kicking off. Just keep in mind that this is very likely nothing more than a relief rally. It would be short covering rally, maybe a slight bear market rally. Certainly not the end of this move to the downside. On the screen right here is the weekly expected move for the SPX in the upcoming week. It's $120.48. That is 3.36% of the SPX. Now that may sound like a really large expected move, but we've been making 100-point moves in a single day. So yet again, continuing to kind of highlight how far off the volatility is from reality, right? So continue to keep your eye on the VIX. We are no longer in backwardation, which is cool. We slipped out of that. We're back into contango. So England is trying to clean things up, or some of the government over there is trying to clean things up. Definitely want to keep your eye on what's going on over there. Foot to mouth is what caused this entire situation that they have, right? This is a self-inflicted wound that they're dealing with. And, you know, once bit, twice shy, they could easily do, another faux pas and screw it all up again and, cause a flash crash contagion. The contagion is starting to widen anyways. We're starting to see such things in shy, junk, and HYG too. So high yield. So, um, still got to let it play out. Speaking of today, we do have the front end of the curve on auction. Take a look at IRX and see how just absolutely extreme things have been in the front end. A couple of chatty Fed members today, not as many as we've had. Speaking of Fed, I did a little write-up over the weekend on this expectation of a pause. So historically speaking, if you go back through various rate cycles throughout history, getting to around 4.5 is usually the average, right? It's not necessarily their goal. It's just usually what they get to, and then things kind of just peter out from there. And then you got to think about what normal is, and the phrases have started to kind of leak through now in places like Bloomberg and the Wall Street Journal, places like that. They're actually starting to talk about the new normal being somewhere above 3% instead of around 2%. Well, kind of carry that forward. If 3%, which is where we're at right now, if that's the new normal and the Fed wants to be in restrictive territory, then they have to get above 3% because 3% is normal and they want to get above normal into restrictive. All right, so if we carry that forward into November, you got your 75 basis point rate hike, gets us up to 375. We get into this to December, it would get another 50 basis points or 75, which is more likely at the moment. That takes us from 375 to 4.5. 4.5 is the benchmark, right? We just said it. That's historically where things tend to pause or slow down, and we don't tend to hike higher than that normally. That doesn't mean we can't and that we haven't, because we have. But that's generally where it comes in. That would be into slightly restrictive territory, which is what the Fed said they wanted to get to, before they even considered pausing to see how the effects of all of these rate hikes have uh, rippled throughout the economy. So that would be a good starting place to hear the Fed begin to mention a pause, right? That would be the December meeting at 4.5. If you look at February, and remember we would be at 4.5 from December, come into February, they're pricing in another a 25 basis point rate hike from 450 to 475. All right, so that's the highest probability. That would be a pivot away from those 75s, but it would not be a pivot away from hiking, and it would not be a pause. It would just be, we're not hitting you with a 75 this time. We're going to back it off a bit and just hit you with a 25. The amount of change in the last month for what's on the table has been pretty significant. And if you look at what happened in the overnight hours, I mean, at this point, not too much yet, right? But you want to revisit this later in the day, around noon, maybe 2 o'clock. It's a nice thing to do, kind of wrapping up your day. If you're not playing in the power hour, to stop by, look at the changes, how significant they are. So it's very likely that we could get mention of a pause or a slowdown. Anything like that into December would put us on a course for like a Santa Claus rally kind of end of year run towards the upside. Not suggesting we would make it back, to highs of the year, not by any stretch of the imagination. Just that if you think about the historic rate cycles and where we've normally kind of started to level off, we're getting into that. The problem in this one is very much like the problem from 2007 and 8, or from the dot-com bubble, or even from the 95 situation that we had back then, is the amount of global liquidity that's kind of still sloshing around, right? They're trying to pull that liquidity out, and there's a lot of work left to be done, right? And then, of course, the war and energy is still continuing to push hard against inflation, right? We continue to see energy running to the upside. That just exacerbates how much everything costs, and we'll continue to see inflation rise. And if we continue to see inflation rise, then they're going to continue to hit us with more rate hikes. Just wanted to kind of point out, don't stay net short in everything, because flash crashes can happen upwards and downwards. And just, trade in a way that you can defend. All right, volume's a little light this morning. Nothing to be concerned. I mean, it's not that light, right? If it was, say, below 80, I'd be a little concerned. Sitting in the low 140s is not a bad thing. We were in the low 40s last week a few times. It's just a little light. Kind of want to note that, but then it's fine. It's no big deal. We just kind of move on from there. Out of my own curiosity, and I didn't do this earlier, but I was thinking about it. Is to see where we are at here with U.S. dollar Bank of Japan. Now, BOJ came out and had said they were going to actively defend that 145, and they did not. And then the inevitable squeeze wasn't much of a squeeze, gotta say. We got above that 145 and just kind of held the line, and then a little pop, and then held the line, and then a little pop. This is like a quintessential, A textbook example for consistent, persistent price action, right? That beautiful move to the upside once we did get through that 145. Now you can continue to play this. If you don't trade pairs, it's not a big deal. Just use the ETF and go the other direction, right? So if you were trying to go long the US dollar yen, you could go short, say, EWI, I think it is, EWJ. Yeah, EWJ. So you could short this if you think that the pair is going to continue to go to the upside. If you think it's going to reject, say, around that 150 area and begin to fall back down, then you would want to play a long shot here off of EWJ. And you do the same thing for like Canada, China, Europe, Britain, whatever. Just use the pair, right? Or just use the ETF tick the other direction of what you think it's going to do. That way you don't have to like go and get a whole new account just to trade Forex. The thing is, though, there is still targets to the upside here. This is not slowing down, although we are inside candle. At least, we were a little earlier today. Yeah, we came back in. So we're still inside of yesterday's price action. And this is getting into territories that can break things. And again, contagion, right? Everything is globally connected, whether we like it or not. If this continues in that runaway freight train maneuver that's going on here, this parabolic rise, this can hurt us. It can hurt the globe. So we don't want to see it kind of get out of control. If it continues to move to the upside, that's not really the issue. It's the rate of change, how fast it's moving to the upside. That's going to be the issue. So we really want to kind of see this slow down a little bit. Watch for any inverse market relations, and just keep an eye on it. As long as this continues to persist higher aggressively, then we want to be very careful about the S&P and the NASDAQ going down. Right? And this is all part of that flash crash scenario that's going on right now, or risk that's going on right now. I did mention it at the start. We do have the front end on the auction today, 11:30. The 3-month and the 6-month. All right, so we're up 1%. We have an ADR of 2.8, so plenty of room to go to the upside. Right now, the ADR to the upside, we're at the ADR half. We still have the full ADR sitting way up here at 36.94, but that would still be sitting inside of yesterday's price action. So making an entire ADR to the upside would still not get us out of the box. And as long as we're inside of this box, we cannot have a trend day. Now, my language for a trend day is completely different than maybe somebody else's language for a trend day, but you can find trend anywhere, like literally anywhere, even in the most sideways of markets, right? Like this. I'd say that's a pretty sideways market. I can find trend in this if I wanted to, right? All we got to do is go to a small enough time frame, and even these 5-minute candles would lay out into a very beautiful trend here, right? So trend isn't the issue. It's a unique, specific thing called a trend day. It's specific, like a head and shoulders is specific, or a cup and handle, or a flag. That there are characteristics that need to be met, or it can't be called a flag, or a cup and handle, or head and shoulders, or a trend day. One of the trend day characteristics that need to be met, or criteria, is that we cannot be inside of our own Globex price action, and we cannot be inside of yesterday's price action. If we are, then we cannot have one of my trend days. We can trend, we can have consistent, persistent price action. It just wouldn't be one of my trend days. So we're very likely not going to get one of my trend days today unless we break below yesterday's low, or even more unlikely that we break above yesterday's high and then begin trending. Getting above yesterday's high is not too big of a deal. We can get there. But begin to trend after that would kind of be unlikely. So ADR half, we are there, 36.42. ADR full, 36.94. Then we got the cash open, 37.07. Got a cog line at 37.11. Previous week's high, 37.33. Now, technically speaking, that's not out of reach. Things have been volatile enough that we could reach that. Notice if we do break outside of yesterday's price action, we will also be breaking outside of the weekly expected move, which is basically at 3,700. It'll be an easy one to remember for the upside this week. Now, while I'm out here on the daily, we'll talk for a minute about what you have to begin considering that you're getting a new trend. You need a full set of higher highs and higher lows. So at the moment, we have a low and we have a lower high. Lower high, lower high, lower high. So we need a rally this week to get above at least Friday's high. That would give us our very first higher high. And then a pullback that does not go lower than Thursday's low. If we can manage that, then we would have a higher low and a higher high, to then get another higher high and another higher low, and that's your full set. It's 2 higher highs and 2 higher lows. You can also use, say, the benchmark of that 3,800 zone. If we get above that and then get our pullback like a Busby against it, that could also be considered a part of a new bear market rally. It would be something, what I'm looking for if we do start to get one, is that it'll be a lot like July-August rally. That we kind of base along the lows for a little while, then we start to pick up speed, and we start breaking out, and we begin heading towards that year-to-date VWAP and the 200 period moving average, right? Remember, that's what we hit our head on in August when we deflected. If we do go back and look at July, August, it's easier just to start at the end and move backwards. It wasn't just we set a low and away we went, right? We set a low, we had a few false starts, kind of based around for a few weeks, and then we started to take off. So, first we based in June, but we really didn't start to take off until a month later in July. Here's October. If we don't start taking off for a month, that puts us into November. We start taking off right into that Christmas rally again, right? You see how everything is starting to just line up. Now, again, I'm not talking about ripping back up to 4,800. I don't think we can get above this year-to-date VWAP and make it stick, and I don't think that we can hold above that 200 yet. So 42, 43 at the absolute max, that would be a surprise to even get that far. It'd be more likely 41.5, 42, somewhere in there, right? The point is, we're primed for another run. I wouldn't run out and just start buying a bunch of stuff to go long, because we're primed for a long. We actually need to start, seeing some opportunities first. Just be open-minded to the fact that you don't want to be net short, and that after a couple of false starts, we may begin to move to the upside, which means at the very least putting on some credit spreads along these lows using the ES or the MES. You could put on some naked puts, say around the the 3,000 area, right? And at the very least, I mean, that's a mortgage payment. Got to put food on the table. So we talked about the upside move, but price can do whatever the hell it wants. What if we go down? We would first need to break the VWAP, not a big deal there. Weekly pivot point, which, as I've stated before, when we're above the weekly pivot point, we're net bullish, and when we're below it, we're net bearish. So if we get below that, it'd be a little bit of a market reversal at that point, going from we should be looking for long opportunities to I guess we're going to continue to look for short opportunities. Then back through Friday's close, Friday's lows, our own Globex lows, and we'll continue to work through Thursday's price action. ADR half is 35.40 and ADR full is 34.88. There is a COG line, 35.11, 36.11, 37.11. We're starting to get a lot more volume nodes around that 36.80 area, and we've got a significant amount of volume right around where we are right now. We actually managed to get above it after some fight and some resistance. It's not the point of control, but it's very close to that. I wouldn't be surprised if after we lose a few more of these candles back here on the left side, that the point of control doesn't significantly shift from its current location. Remember, we still have all of this candle pattern across the top, that 3,800 and all that volume up there. Now, granted, even looking at it from this point, I don't think that these candles here in the left, I don't think they're enough combined with this that we'll lose our point of control and that it will shift all the way up to 3,800. I don't see it. I think it might just shift into the 36.40 area. Still, we're inside the box. When we're at the low of the box, we expect to go to the top. And when we're at the top of the box, we expect to go to the lows. We're kind of sitting in the middle. A move to the upside, while there is some resistance, it does have a really great shallow area if we can get above, say, 3,700. There's not a lot to carry forward here. Looking at the 5-day, 5-minute volume profile. There's no points of control that haven't been hit. And the value area high and low, I mean, you can carry those forward. I don't. I'd rather just carry the open, high, low, close. But, you know, to each their own. Here you can see that shallow area on a day-by-day basis. If we happen to break through our own Globex high, then we'd have this nice shallow area. And it's worth noting that this pivot point, a place where I would normally be concerned, you know, you look left, you see a pivot, and you say, okay, well, if we break to the upside, I got to watch that resistance. There's no real volume resistance there. I mean, there's a little bit, right? Just a little bit of volume right there. Not a lot. We might actually be able to get through that easier than anticipated, right? Certainly, there's like none there on that one. Same thing, though, to the downside. If we do happen to break Friday's low, we got a very shallow area to work through from Thursday. So we could find a little bit around 35.5, a little bit of support, and then below 35.5, 3,500. So if we do break down, we'd expect at least one touch bounce there and then another touch bounce Whether they hold or not is a completely different discussion. They're not just places where we could potentially bounce, they're targets. So kind of keep that in mind. Banks continue to surprise in a pleasant way, but it kind of kicks the can down the road. If they're looking for demand destruction, wealth destruction, and a sponging or a removal of liquidity, we're not. Let's say it another way. There's these bubbles that need to pop, and one of those bubbles is an earnings bubble. Okay? We're trying to get back to a more normalized earnings. Well, that comes from putting so much pressure on companies that they just can't sustain their current rate, right? We higher unemployment numbers. We want to see layoffs. We want to see that, they're not selling as many products. They're not making as many products. There's not a demand for their products. Banks usually lead earnings seasons, right? And so if banks do bad, we usually see bad across the rest of the earnings. And then when banks do good, we see good across the earnings season. We need to start seeing bad earnings. And so far, I mean, sure, there's a sprinkling, but it's not as bad yet. So higher for longer, right? Higher rates for longer. That we're likely to not get that pivot anytime soon, unless something breaks. So $90 is the benchmark, or this last pivot here from June. If we get higher than that, inflation is going to ramp up even higher. So 93.3 kind of be a line in the sand. And we do have that really nice head and shoulders, which measures out just beyond that. So if the daily head and shoulders on the XLE does play out, that would be getting us above 93. Now, careful with the idea of, whoa, maybe I ought to just go long in energy versus crude, right? And I continue to see this mistake frequently. Crude is very likely going to be manipulated as we come into the elections, right? They got strategic petroleum releases that they can do, artificially lower the prices at the pump. But anything that shuts a refinery down, whether it's hurricanes or whatever it happens to be, a lack of refining can directly affect the pumps. But keep in mind, after the election, any effort that was made to artificially suppress pump prices is going to go away, and we'll start getting into the holiday season when fuel normally rises anyways. And that's all fuel and crude and oil, and not XLE. XLE is a bunch of companies, and this is a marketplace full of companies. So high correlation coefficient, I love that big fancy word on a Monday morning. If we rip to the upside across the board in everything, that also means energy. Utilities has taken a significant beat down over, say, the last month, and it was impressive. I've heard some, really big named people out there talking about this boring ETF XLU, because in the last month it hasn't been so boring. That thing was a face ripper. Expect a little bit of rebound now. Right? Take a look at that thing on a monthly chart and a weekly chart. Kind of plot out some levels, and you'll see that there's this beautiful tag to the upside. I don't think it's done going down, by the way. But, I can see it coming up into that 200, which would be right around $70. So a good $8 move to the upside. Got a little bit of sizzle this morning. In gold. Financials, healthcare, emerging markets. Now, emerging markets, this is kind of our gauge for speculative risk around the world. But if you look at the names that are kind of piled in there, it's really more of like a proxy for trading China. Either way, seeing emerging markets strongly up in the pre-market kind of puts a check mark in the idea that we're seeing a risk-on appetite. Right, it's that bullish continuation through the day. Now, of course, it can still flip. Everything can flip. Right, we're not in a marketplace that can just be expected to sustain and contain a move. All right, so I mentioned we're not in backwardation anymore. 1 month volatility is at 32.11, 3 month is at 32.45, and 6 month is at 33. So it's curving higher, and that's what we're supposed to see. So that's contango. Volatility on the volatility index is picking up just slightly, but not enough to be concerning, especially since that's a Friday print, right? So we want to see that print Monday once the market opens, and we want to see that it's continuing to point lower, right? Because that's the VVIX is a great way to say it is that it's the implied volatility indicator for the VIX. Now, it's really not that, but it's the best visual that I could give you mentally to every time you look at that thing. Just think it's the implied volatility indicator for VIX. And that just gets rid of all the nerd speak, right? Kind of puts it in plain English. We want to see skew continue to normalize, although let's go look at skew for a second. We're still sitting at some critical level. You can see we're at lows that we don't normally visit a lot. I go back 20 years. Now we're not at the lowest that we've ever been, but sitting on the low end of this curve. Skew is like the marketplace's expectation that we're going to make a +2 standard deviation move in SPY. Now remember, we've been moving plus 100 points in the SPX on nearly a day-to-day basis. A 2 standard deviation move in the marketplace would be like a Bollinger Band move, right? So that's using 2 standard deviations. If you were to go out to a daily chart and look at the SPX or the SPY with the Bollinger Bands on, imagine that it could go from the midpoint of a Bollinger all the way to the top of a Bollinger in a single afternoon. That would be a 2 standard deviation move. That's what this is measuring. Skew. It's the expectation that we could get a 2 standard deviation move. Expectations apparently are very low that we're going to get one of those. It just shows how broken these systems are. Everybody out there is talking about flash crash warnings and be careful, it could be really bad. Flash crashes can go up, by the way, so we're not all looking down. But this gauge says money-wise, people aren't spending their money that way. So remember, when it comes to the institutions and the bobbing heads on TV, what they say is one thing, what they do with their money is another. And, you know, Lisa Abramowitz is always talking about follow the money. Well, there you go. Looks like we're starting to get a little bit of a breakout in the US dollar Japan. 151 is the next target higher on that, by the way, you know, if you want to continue to play it to the upside. We're still not seeing any stabilization in bonds. So it yields higher, bonds lower. This sideways move in the dollar, should have covered that better. Let's go talk dollar for a minute. When it comes to the S&P and the NASDAQ, we kind of want to have some benchmarks in place for what we would see in the rest of the market that would give us a little bit of pause. So with the dollar, if we can break below this 112, we very likely are going to get a stronger rally in the S&P and the NASDAQ. But that's like a day-to-day level. On the week, or maybe a little bit of a bigger picture, would be the 110. If the dollar maintains above 110, then I don't see that we're going to get a July-August rally. Let's say it that way. For that July-August rally to really have the fuel to make the move, we got to see the dollar below 110. You don't get that, then the current rally is very likely going to hit its head against resistance, and that'll be that. At the moment, it's just a short covering rally. It's not even a bear market rally yet. And the other side of that benchmark would be, we'll call it 114.5. 115 just rolls off the tongue better. 115 to the upside. If we break above that, we're going to see new lows in the S&P and the NASDAQ. And we're not talking about wicking down to new yearly lows. We're talking about in an entire leg down lower. So there's your solid benchmarks for the swing trade and being able to maintain the range. The VIX, as I've demonstrated all morning, is not to be trusted. The VIX, the VVIX, the skew, everything is pointing to this being still heavily manipulated. And that's not, tinfoil hat conspiracy theories. Barclays getting sued right now because they got caught manipulating this thing. And it's not just Barclays. There was other names mentioned. There's been heavy manipulation this year. Heavy enough that they not only got caught, but that they're attempting to prosecute. So, you know, it had to be pretty heavy. And looking at it, it's not done yet. So while this is a slightly useful tool for benchmarks, right now I think the dollar is going to just give you a better service. $30 is still the line in the sand. If we break below $30 in the VIX, that will be another check mark for a July-August rally like we had earlier in the year. As long as we're maintaining above that $30, I don't see that we can get that July-August rally. And that we're more likely, if we stay above 30, to just get a few days of a rally, a short covering rally, and then roll over again. Having said that, the other side of the coin would be if we get above 35. If we break above 35, then it's very likely a solid check mark for a new leg lower. I couldn't make it any clearer than that, right? That's two solid benchmarks that you can use to kind of validate or confirm that the move up that you're seeing in the S&P or the NASDAQ is actually going to follow through. So we've got a potential TRB, be a trendline breakover. We need higher highs and higher lows in a full set. We've got gaps to fill. $37.07, well, $37.06 is the channel bottom of this gap. We'll need to get through that first, which will be a significant level of resistance, but once through it, it'll be our support. And then the gap close is 37.44 and a half. And that would have a firm TRB at that point. So put spreads or naked puts, using the futures. And when it comes to, I've seen a lot of talk about flash crash puts. It's not a bad idea. Apple flash crash puts are costing, I think it was like $100. You can certainly go cheaper than Apple. If we stay in a highly correlated coefficient and we flash crash, everything's going to go. So take your pick. XLF is cheap, and it, technically speaking on the year, it's not as down as, say, other sectors are. Buy puts in XLF. If you're using a small account and you don't want to put $100 on the line for a lottery ticket, which is basically what we're talking about, spend 10 pennies and get XLF puts or XLI or XLY. It doesn't really matter. If we flash crash, everything's going to fall, right? Except, of course, like the VIX. So buy puts and whatever you want. The idea would be look for like a 2 standard deviation move and then buy, puts in that range. If you don't know how to do that, then do cost. And we're talking about getting through October and into November. So with your flash crash puts that you're looking at, try to target something like the monthly expiration for October or the monthly expiration for November. Mainly the monthlies are going to have more liquidity. And if you buy them too close, say you buy Friday's puts, well, then you're just going to have to buy next Friday's puts and then next Friday's puts and then next Friday's puts. And technically speaking, there's not really anything wrong with that other than cost, commissions. So I randomly picked an ETF XLI. The market's not open, obviously, and our pricing is all jacked up. But I will point out, look at the spread width here. And of course, we would expect that to normalize a little bit. But that's $230 of spread differential. That's just absolute trash. So let things open a little bit. This is why when we talk about buying flash crash puts and things like that, we try to keep it into the most liquid thing that you can get. SPY. There's nothing more liquid than SPY. Once the market opens, this will very likely have 1 penny differential in the bid ask. But look at the cost of these things, right? So for, say, Friday's expiration, we've got an $11 expected move. If we were to flash crash, it would be at least twice that. So instead of $11 out, you could go $22 out, and that would put us at, say, $340. There's your $100 for your lottery ticket. If you don't like the cost of that, you could turn it into a debit spread. I mean, it's not going to pay you as much, right? Because you're capping your profit, but you're also going to cap your loss to 10 cents. So this is risking 10 cents to make 90 cents. I would argue you'll never make 90 cents on it, but I could also argue you don't have to lose the full 10 cents either. In a land of rainbows, butterflies, and sunshine, you might make 2/3 of that 90 cents, 60 cents. So you're risking what, 10 cents to make 60? That's not bad on a risk to reward scale. But the idea of buying flash crash puts is that it's supposed to offer a pretty good payout, if you actually get it right, and or a little bit of protection. I would argue most of us don't need put protection since most of us aren't carrying a bunch of long stuff. But I don't know what you're carrying. The width of the spread would not affect the outcome of the trade, so you can make it as wide as you want. The wider you make it, the more money you could potentially earn. But on the other side of that, it's very likely the more money that you'll have at risk too. So the width of the spread will not affect whether you win or lose. If you make it $20 wide or $2 wide, if it loses, it's going to lose. And if it wins, it's going to win. Either one of those would win and either one of those would lose. Which is nice because it means you never have to get hung up on, well, gosh, if I'd have just built that spread a little bit wider, maybe I wouldn't have lost. Nope. If we don't crash, both of those are going to lose, whatever size you make it. When it comes to the most liquid stuff out there, Apple ranks pretty high on the list normally, and then SPY. But you could substitute SPY for QQQ, or there's those double and triple leveraged products out there. Again, when it comes to a flash crash, if we do go down, well, we can crash up too. So if we do make a 2 standard deviation move, everything's going to go. High correlation coefficient. So as we come into the open, you'll want to be looking at, say, the Visualize tab. You come in and set this to the index watch, pick your index. So say the NASDAQ 100. In a high correlation coefficient, this is 100 names. We would see 97, 98, 99 names all doing exactly the same thing. Everything is going to respond to a crash. What we want to see this morning, today, to validate, is this a short covering rally? Start looking at the Wall Street bet crowd, all those BBBYs, AMCs, GMEs, anything that fits that short squeeze, short covering rally name, including KWEB, which is an ETF. This is like a China ETF, technology ETF. So it does a really nice representation on that discussion. ARK and names in the arc fit that short covering rally benchmark. So you're going to want to see KWeb going to the upside and a bunch of those Wall Street bet names moving to the upside. And then you can use the Discord and you can run bot commands to see things that have a high short float. Let's see. And speaking of bot commands, you can use Discord to set alerts on stock prices, right? So say I want to know when Apple gets above 370. I got Apple on the mind this morning, I guess. Equal or above 365. I now have an alert set, and Discord will notify me with a chart if SPY gets above that level. And the notification looks a lot like this. It'll pop up, and it'll say, "Hey, you got your alert." So AMD is on that list. These are not exactly what I was looking for, but they'll fit the discussion for this morning. Short interest stocks. Ford, Apple, the Qs. There's what we want. HSI. All right, BBBY, as I mentioned, Beyond Meat, Big Lots, and these names have been on there for a while. I mean, these are not so far surprising. Upstart Holdings, MSTR, Huron, Big Five has been on there for a long, long time. That's not a new one. Carvana, yeah. I stay away from that name. Keep looking for that one to dissolve. Nokia, Revlon. You're going to be. I'm not suggesting trading these names, by the way. You want to use these names like an indicator. If they start catching bid and moving in the pre-market, or even moving through the day today, they're going to indicate that there's this short covering rally going on out there. So by all means, I'm not suggesting trading this junk. You don't want to trade this junk. They just make for a really great indicator. Lump them all into one spot, and you can kind of get a feel for how they're doing. Thinkorswim actually allows you to make your own ETF. So you could go in and you could start putting all those names together, just separate them with a plus sign. All right, so we got KWeb, you could just add BBBY, a little plus sign, right, Big Lots, and you could just keep doing that. And when you're done, you would have this homemade ticker symbol of all of those short covering names all wrapped up into one chart that you could keep your eye on. And what you're looking for is that they're catching bid this morning. Be a part of that short covering rally that we're talking about. We're looking at a heat map here of the S&P 500 filtered down to as close to 100 names as I could get. Change the color scheme a little bit, and what stands out are the monsters of tech. They are the biggest boxes because the boxes are representative of market cap. So the bigger the box, the bigger the market cap. The bigger the market cap, the more influence the name has on its index. The FANGs, or the monsters of tech, they stand out, right? Amazon, Apple, Microsoft, Google, Tesla. Now, if you use the NY FANG, that has Alibaba and Baidu and PayPal and Twitter. It's this benchmark that is maintained by whoever built the darn thing. And you don't have to worry about what names are in it. Otherwise, you got to try to keep up with the current latest acronym. Remember, it was FANGs, and then it was FANGMAN, then it was FANGMAN plus T. It keeps changing, and names keep popping in and out of it. You can make your own, or you can just use that NY FANG. It's a nice little benchmark, gets it done. The point is, technology is on the rise this morning, and what we've been fighting a lot in the last 2 weeks is technology versus finance. So if we start getting tech and finance working together, we're going to really see a move to the upside. So we want to see an inside day breakout on NY FANG, KRE, that'd be tech and finance combined. And the ticks, they were bullish divergence last week. They continued to point to an upside move. I mean, heck, we broke out to the upside in the ticks. So the ticks were pointing to a bullish continuation or a bullish divergence. The S&P and the NASDAQ and the market was still, bouncing along the lows after that Thursday rally and Friday dump. But this was still pointing higher. Lots of analyst rate changes this morning, and I bet if you was to go in and look, you'll find a lot of monsters of tech got rate changes. I know Apple was one of those over the weekend that got a rate change because I posted it on the 15th, which is what, Saturday? Going long on Monday, new bear market rally begins. It's almost like you couldn't just write a book, right? You couldn't make this stuff up if you wanted to. How did I know that we were going to be long Monday? And China Tech, Alibaba, Baidu, on the rise this morning. It fits right into that short covering rally that we were just talking about. The reason behind it, right? The why, that's just a bullshit narrative, right? They just come out with, they make something up. It's the fact that those names are rallying. So keep your eye on those high short names. Look for a market rally. And remember, we sell the rip, not buy the dip, until proven otherwise. This is very likely going to be the start of another rally like we had in July and into August. But until we start to get some key criteria, I wouldn't trade it that way yet. The really good thing is you can start going long, you know, by, say, selling a credit spread down here. And you could even sell a credit spread to buy those puts that we were talking about. Right? Use the money you get from the credit spread to pay for the puts so that you have flash puts. That's what I got, everybody. Be careful, be safe. Continue to look for signs that this current move to the upside is actually going to be a July-August rally. That it's going to have a little bit of sustainability to it. And remember, we're not talking about, you know, reclaiming the highs on the year or any kind of language like that. I don't see that we're getting past this pivot point here. I don't think we're even going to get anywhere near that, but still. Have a good one, everybody. I'll see y'all tomorrow.
Recording